Well, thanks again for joining us. Real quickly, we've got to go through our disclosure. This just lets you know that basically past performance is no guarantee of future results. If we're talking about the last week, you'll probably hope that it's not indicative of future results, but we'll make comments on here about future expected returns and past returns, and just simply know that nothing's guaranteed. So real quickly, you should have gotten an email from us here over the last couple of weeks that we've expanded our team. So before we jump into our content this morning, I just wanted to make sure everyone had a chance to meet the two newest members of our team that joined us at the beginning of the year. So they've been on board for a couple of months now. We've been blessed with very steady growth over the past decade, and this has been primarily driven by client introductions. So for that, we thank you. But in order for us to service our new clients and not dilute our service levels or our responsiveness to our long-term clients, we've needed to grow the team. So we added 2 new people this year, and this is going to allow us to primarily do 3 things. We're going to be able to continue to build a firm that will survive me long-term. Most importantly for me, we'll be able to advise all of our clients throughout their lifetime, and they'll never have to find a new advisor. For a lot of our clients, if you match up my age with their age, chances are I'll retire before you pass away. And we don't want clients, especially late in their life, to have to go find new advisors. So we're building out a team that will long survive me. We'll also be able to serve families for multiple generations. So when the first generation passes assets to the second generation, we'll be in a position to help support both generations for decades to come. And then finally, we've got the capacity now with 3 seasoned financial planning professionals on our team to continue to support our current clients, their friends, and their family members they introduce to us without diluting our work with our existing clients. So the 2 newest people that joined us this year, on the left, you'll see is Joanna Adelson, and on the right is Bryn Penner. Joanna joined us in January on the advisor team, and she'll be helping support both Katie and I in servicing our existing clients, as well as taking on a leadership role as the primary advisor working with some of our new clients as we grow in the future.
Good morning, everyone. So I recently moved to Boise from California, originally from the Central Valley, but spent most of my time in the Bay Area. I worked as an advisor for a firm in Palo Alto, a firm very similar to Aspen, working with dimensional funds, structuring portfolios with tilts towards small cap and values companies. I've also worked extensively with clients building financial plans, working through all aspects of their financial life and helping them achieve long-term goals. I'm super excited to be part of this Aspen Capital Group and look forward to working with you all.
And then Bryn is on the right in the picture. Bryn also joined us in January as a member of our operations and client service team, where she'll be working with Rachel, which most of you certainly should know by now. Bryn's role this year will primarily focus on being the interface between our clients and our custodian, TD Ameritrade.
Hi, like Mike said, I'm Bryn. A little about me is that I'm the only native Idahoan on the team. I was born and raised in a small town and then graduated from the University of Idaho in Moscow, to Mike's displeasure since they're direct rivals of the Boise State Broncos. Prior to joining Aspen Capital, I worked for an insurance and financial planning firm in Boise. In this role, I will be working alongside Rachel on the operations team, and I'll be the primary person scheduling your portfolio reviews and taking care of cash management requests and answering any login or operational related questions you may have. I'm so grateful to be a part of Aspen Capital team, and I cannot wait to meet each of you.
Well, it's very kind. We've already had our first input via the chat bar of today. So Phil, thank you. Phil sent a welcome message to both Joanna and Bryn. So again, just a reminder, if you did join us late, we've got the line muted so that we don't have a lot of background noise, but we do want to encourage you to ask questions. If you take your mouse and you just hover to the bottom of your screen, you'll see a chat icon on that ribbon on the bottom of your screen, and you're welcome to type in a message and send it to us. And that'll come through anonymously, so you don't have to worry about anybody else seeing your question. So thank you, Phil. Appreciate it. So taking a look at the agenda for today, a little different agenda than we've had in past years on this. We've got a whole lot of different financial planning related topics that we want to get to today. And as we were putting this agenda together a couple of weeks ago, we didn't have a placeholder on it for the coronavirus. But we quickly realized about 2 days ago that it was a topic that we were going to need to address today. So we'll start off with some quick thoughts from us on the coronavirus, and then we've got several different topics. The team's going to divide this up and share our thoughts with you on several different topics. And again, please make sure and use the chat tool to ask us questions as we go. We know that the coronavirus is certainly on top of everyone's minds. The markets have been very active, if you will, this week. So please, if you've got questions, fire them away at us. Let me just start on the coronavirus, though, by saying we all recognize that by no means are any of us specialists in either viruses or diseases. We've got some thoughts on how these things impact your portfolios, but outside of that, we're certainly not the right person to ask any questions with regard to the actual viruses themselves. What we can do, let me give you a graph here. So what we can do is look at how financial markets have reacted to health scares and viruses in the past. So while the coronavirus is new, we've had numerous global viruses to deal with over the last 20 years. The chart that we're showing you here is a chart, the blue line is simply tracking the appreciation of global equities over the last 50 years since 1970. And what it's plotted on it is a number of the health scares that have struck in the world over that 50-year period, with most of them really happening in the last 20 years. And when you look at the history of global equity markets, you see in just the last decade, we've faced the swine flu, Ebola, and the Zika virus, not to mention the coronavirus we've got today. While each of these was important in their own right, and they each caused some short-term market volatility, none of these viruses we've faced in the past decades have created any long-term market disruptions. While we absolutely expect the coronavirus to have a short-term impact on global economic growth over the next couple of quarters, you can see that historically, on average, markets have positive returns 6 months after the virus outbreak. So that's the box in the upper left-hand corner here. And what it's simply showing you is 1 month, 3 months, and 6 months after the outbreak of the virus, what's happened to global equities. And you can pretty clearly see that once you get about 3 months out, and certainly once you get 6 months out, markets have calmed down and have resorted back to positive returns. With such short-term market impacts, the only way an investor can profit in an environment like we're in is to correctly predict the optimal time to both exit from the market and re-enter the market. We're confident that not only are we not capable of precisely timing the market in both directions, we don't think anyone else is either. So with this in mind, we have some thoughts for you on how we view your portfolio in the midst of this coronavirus issue. First, we'll certainly have at least a quarter and likely 2 to 3 quarters of impact on both global economic growth and corporate profits. You're certainly seeing that being priced into equity valuations this week. Second, the current market downturn gives investors an opportunity to invest cash at lower prices. I myself have been a buyer this morning for 2 different clients that have been able to transfer money in the last day or so. Global equities have gone on sale. So if you have capital available, you're comfortable investing for the long term, we'd encourage you to contact us to discuss putting a plan together to invest the cash. We know we're unlikely to be lucky enough to actually accurately predict the market bottom, but you'll have an opportunity to buy assets 15% cheaper than they were just last week. Third, remember that not all assets have declined in value this year. Our clients hold diversified portfolios owning several asset classes. So far this year, our largest bond holding has increased in value about 3.5%. So just as they have in the past during times of equity market volatility, high quality bonds are acting as a great diversifier to stocks and increasing in value when stocks are down. And as a result, chances are your aggregate portfolio return is not nearly as bad as you may think based solely on the news headlines and the equity market indices that you may follow. And finally, we would suggest no changes in your overall portfolio allocations. As a long-term investor, this is one of the times every few years where we're rewarded for our discipline and patience. We will, of course, look for opportunities to rebalance portfolios and tax loss harvest over time. But other than this, we would encourage you to sit tight. Let me pause for just a second and see if anybody has any questions on this. If you do, again, feel free to go to the chat bar at the bottom and enter any question you've got.
Okay, if no questions, this is Katie, and I'm going to move us into 2019 and taking a review of 2019. So we just talked a lot about present day, what's happening now, and I want to take a step back and look at last year. So let's take a quick trip down memory lane. What do we remember about 2019? What happened? What were some of the headlines? And how did we start out the year? Well, if you remember correctly, the market just had a rough finish to 2018, and 2019 started off with uncertainty. Experts were forecasting that the S&P 500 might have topped out after one of the most powerful bull markets in history, and they were also forecasting a possible recession. So, how did we end up? Take a look. Well, before we actually look at the returns, sorry, let's go back. Okay, so before we get to the actual returns, let's remember some of 2019's biggest headlines. So if you remember, right, the trade wars were all over the news in 2019. They started actually back in 2018 and kind of plagued the headlines throughout the entire year. In July 2018, President Trump followed through on months of threats to impose sweeping tariffs on China for its alleged unfair trade practices. And then for months following, the two countries have been embroiled in countless back and forth negotiations, a tit-for-tat tariff war, introduced foreign technology restrictions, and have consequently led U.S.-China trade tensions to the brink of a full-blown trade war. A lot of uncertainty has plagued American investors around the topic of trade wars and how they might affect corporations and overall returns. So huge headline there in 2019 and a lot of uncertainty around that. Let's look at another headline from 2019, Brexit. We've heard this a lot. In June, Theresa May failed 3 times, so her third failure to pass her deal with the EU through Parliament. She officially stepped down in June, causing the media to caution investors about global markets. So some headlines about global markets and stock swapping as Brexit fears resurfaced. This was really hard on international equities that we saw, mid-year. Another headline from 2019, President impeached. So we don't see this every year. We've seen it before, but not every year. And this was another major headline that caused some fear in the markets. So on September 24th, Speaker Nancy Pelosi announced a formal impeachment inquiry into the president. On December 18th, the House voted to pass 2 articles of impeachment against President Trump. The first charged him with abuse of power, and the second charged him with obstruction of Congress. So that's a lot of kind of doom and gloom in the headlines. So how did the market respond? Well, you can see here all of that green. The market was only happy to prove the headlines and naysayers wrong last year. So let's look at this graph really quick and let this all sink in. So US large cap equities were up over 31%, or just right at 31%. US small cap was above 25%. International equities above 22%. Emerging markets were up. Global REITs were up above 23%. And bonds, a big story there, bonds were up over 8.5%, around 8.7% for last year in 2019. So what can we take away from this? By the end of 2019, the S&P 500 was up nearly 40% since the low close on Christmas Eve of 2018. At this time, it's always much easier to look back after the fact and think, man, early 2019 was a great time to buy. In hindsight, it's easy to make that judgment call, although in the moment it can feel very scary. And when we're in a season like right now, where headlines are loud and investors are reacting, we can choose to look at the correction as a wonderful buying opportunity. So in quick summary, what we saw last year was actually better than expected outcomes in the US economy and around the globe. So what can we learn from that? Let me say this kind of slowly to let it sink in. We believe that markets are priced at such a level to keep expected returns positive. What is better than expected comes to happen, like it did last year, you get higher than expected returns. If what's worse than expected comes to happen, well, then you might end up with disappointing or lower returns. It's really that simple. So if you would have started 2019 by reading the headlines and reacting to some of those headlines that we saw and making trades and selling positions, you might have just missed out on one of the best equity markets in over 20 years. Something to think about, especially right now in the current market environment and all of the activity we're seeing. So that's a little bit about short-term performance and what we've seen. I'm gonna give the mic over to Mike again, and he's gonna talk a little bit long-term performance and go over the past 2 decades.
So we thought it would be a great opportunity. We're 10 years away from the financial crisis. And at that 10-year mark, we thought it would be a great opportunity for us to take some time in this year's webinar to really go back and analyze the accuracy and the success of the conventional wisdom we were led to believe in different times historically. Oftentimes during different market environments, the industry experts, or shall we say market gurus, have their opinions and forecasts shared all over the media. No matter where we get our information, whether it's in the financial press, on the internet, or even the nightly news, there's always an industry expert with a really impressive title who's dressed well and works for a large, successful institution, ready to share their opinions and forecasts. And they typically do so with amazing confidence. So we thought we would go back and test how this conventional wisdom played out over the past decade. So you may remember 10 years ago, the very intense weekend in 2008 when Lehman Brothers filed bankruptcy. Merrill Lynch was sold to Bank of America, and the US government spent tens of billions of dollars to rescue AIG. Now, I looked at the list of people that have signed up for this webinar today, and the vast majority of you were investors with us 10 years ago. And I remember the difficult conversations, and I certainly remember the angst in investors' minds. That progressed that year to the US government. It seemed like every week the government had to rescue more financial institutions, investing hundreds, if not hundreds of billions of dollars to save the different banks. And then finally, that winter, it ended with the government bailing out the economy, spending almost $1 trillion in an economic stimulus bill that created a tremendous amount of angst in the capital markets. It was certainly the most frightful and worrisome time most investors, I think, on this call have ever faced. I know this week's been tough, but I think most people that think back to the crisis of 08-09 would argue that that was certainly longer and more drawn out, and it was a really difficult time. So if you go back to that period and you think about the environment that was looming, and you think about the expectations that the analysts forecast in 2009, the first thing we consistently heard was that the economic stimulus, that nearly $1 trillion bill that was passed to provide economic stimulus, was most certainly going to create rising interest rates. And those rising interest rates, the byproduct of that would be hyperinflation. And due to both the higher interest rates and the hyperinflation, that would most certainly create poor economic growth, not only in the US, but in the rest of the world. And finally, the combination of those top three had to create an environment where we would have below average equity market performance for some time to come. Now, this was a period where these weren't just a few experts' thoughts. They were widely accepted around the world as fact. Everyone with an important title had the same set of beliefs, and there were no vocal outliers. Most investors, both small and large, adjusted their portfolios to these new truths. Not just individual investors sitting at home, but large institutions, pension funds, and endowments adjusted their portfolios with the beliefs and the expectations that were created. Bonds would struggle due to inflation and rising interest rates. Equities couldn't possibly perform well with the poor economy that would result from the same set of assumptions. So then we look forward. So today now we look back at the last decade and we say, what was in fact reality? Not only did interest rates not rise, today, literally as we record this webinar today, interest rates, the 10-year Treasury is trading at an all-time low. The 10-year Treasury in the financial crisis was at about 4%. Today, the 10-year Treasury this morning traded as low as 1.22%. It's never traded lower in the history of our country. That hyperinflation that we were expected to experience over the last decade, we've had anemic inflation. We've had the inflation in the last decade is one of the lowest inflationary decades we've had in the last 100 years. And instead of poor economic growth, the United States has been the leader in the global economy, and we've had better economic growth than almost any country, or certainly any major country on the planet. And finally, instead of below average equity market performance, we've had exactly the opposite. Fantastic equity market returns. So why do we go back and rehash the last decade? This gives you an idea of what equity market performance has been over the last 10 years. Starting on the far left, you'll see the 10-year annualized return of the S&P 500 index, really the proxy for US large cap stocks. It's returned on average 13.5% a year for the last decade. That's a full 35% higher than its historic long-term average. As you move across the right, you'll see small cap stocks were up about 12.5% as well in the United States. And as you move to the right-hand side, the one thing you do see is while you see reasonably positive performance from the international markets, their performance has been about half or a little less than half, both in international and emerging markets than the US. they've certainly disappointed versus US equities over the last decade. So why do we go back and rehash the last decade? It's because it highlights that nobody knows what's going to happen in either the economy or the financial markets. They're unknown. And the sooner we can accept that they're unknown, the better investor we can become. A lot of investors, as I mentioned before, both small and large, made substantial adjustments to their portfolios a decade ago to align with these widely accepted conventional wisdoms, and it cost them dearly. While we're very proud to say that this didn't happen with our clients, certainly all of us know someone, whether it be a friend, a family member, maybe a neighbor or a colleague at work, that panicked a decade ago and went to cash. Maybe not entirely to cash, but they took a lot of chips off the table. A lot of people at that time sold equities at the bottom or near the bottom and paid off their mortgage. That certainly did not turn out to be a great decision a decade later, with equity markets up over 13% a year. Many sold assets and bought gold or bought commodities. Again, another disastrous decision over the last decade. US equities over the last decade were the second best performing country of 44 global equity markets. So we highlight these just to highlight to people, when we look back historically, oftentimes the conventional wisdom that we see on the internet, that we see on the news, or that we see on TV in general is far from right. Now, a big question we get right now today when you look at this chart, because remember, this is a discussion about a tale of 2 decades, right? And we've just discussed 1 decade. So if we go back to the previous decade, one of the questions we get a lot right now when you look at this chart is we get the question of, why do I own international equities? US markets have substantially outperformed international and emerging markets for the last decade. Why do I own the rest of the world? And the reason this is a tale of 2 decades is we simply have to go back to the previous decade. So from 2000 to 2009, if we look at that same market performance, you see that in the previous decade, US large cap equities were actually the 40th worst performing country out of 44 global equity markets that are tracked. US equities were actually negative for an entire decade. And as you go to the right, you see investors had substantially better returns in both international and emerging markets. So the simple answer here for why do we invest internationally is because historically, international developed market returns have had very similar returns to US equities. Their returns have simply come at different times. And so there's a diversification benefit historically to investing in international markets. We don't necessarily have a higher expected return. We simply expect to have a smoother ride. So if you look at the markets over a 20-year period, the tail looks very different than just the last decade. You see that US markets on the far left, US large cap equities, the S&P 500 was up 6% a year over the last 20 years. You do see that small cap premium coming into place, where you see US small cap equities were up about 10%. And as you go further to the right, you see international and emerging market equities have returned very similar returns to US large cap equities over the 20-year period. And finally, I think the good old-fashioned returns quilt is always a great way to sort of visually summarize this point. What this graph is showing you, and we're happy to email you a copy of these slides because I realize this might be hard to read. But this is taking every year for the last 20 years. And then on the far right-hand side, it's showing you the 10-year average returns and the 20-year average returns. And it's simply ranking the different asset classes by their returns. Okay, so if we go to the very far right and we look at the 20-year annualized return, at the top, in the very top right corner there, we see REITs, or real estate, has been the best performing asset class over the last 20 years. Now, if your eye scans to the left and you look at that blue box, you see how random their returns are. And in fact, that's the case for all asset classes. They have great periods, they have poor periods, and investors have got to be able to own them over the long term to capture those returns. So with that, I see I've got a question. I would encourage you, any questions, please let us know via the chat bar. So we got a question, what was the best performing equity market? I'm not exactly sure over what time frame this question is being asked for, but I think this chart right here actually shows, depending on which year you're looking at, or whether you're looking at 10-year or 20-year returns, you can see what the returns have been. If we focus on the far right-hand side, the 20-year returns, you can see real estate's been the best performing asset class. US small cap equities and mid cap equities were right behind that. Very interestingly enough, over the last 20 years, emerging market equities, the yellow box there with a 7% return, were almost a full percentage point higher than US large cap equity returns. And then as you go down, you see the returns of bonds, as well as at the very bottom there, you see the returns of commodities. And I would just say, if anybody ever questions or wants to know why we don't invest in commodities as an asset class, this chart's probably a really good example. You can see that both over the last 10 years and the 20-year period, commodities have not only been the worst performing asset class, but most importantly, they've actually had negative real returns, meaning the return net of inflation. So great question. Any other questions on the last 20 years and maybe just portfolio diversification in general?
Okay, so this is Joanna, and I'll be going over the Secure Act. So at the end of 2019, Congress passed a major retirement bill known as the Secure Act, or Setting Every Community Up for Retirement Enhancement Act. It was the second largest tax bill passed by the Trump administration. The changes are effective January 1st of this year, which pertain to IRA accounts and retirement plans. I'll go over the two biggest changes that are most critical to US clients. The new bill changed the IRA required minimum distribution age to 72. Before, that age was 70 and a half. If you are currently 70 or 71 years of age and have already begun your RMD, you will continue to take the distributions each year. Unfortunately, you're not allowed to stop the distribution for the year and begin at 72. Some planning points to consider are Roth conversions in years post-retirement, but prior to Social Security when your income is low. As a reminder, a Roth conversion is when you can take traditional IRA funds and convert to your Roth account, allowing for tax-free withdrawals down the line. We will continue to reach out at the end of the year and work with you and your accountant to determine if a Roth conversion is appropriate. Another planning opportunity is making charitable donations out of your IRA account. These are known as qualified charitable distributions. You can make the donations directly to the charity from your IRA account when you have reached 70 and a half years of age. Any amount you gift count towards your RMD amount and will not be considered income. We recently sent out an email to eligible clients for these QCDs and will continue to do so each year. The next important change regards inherited IRA accounts. These are IRA accounts that are passed down to non-spouses, such as children, nieces, nephews, etc. The old rule was when an IRA account was inherited, the beneficiary was able to stretch the required minimum distribution over their lifetime. That's no longer the case. Now beneficiaries will have to withdraw the entire balance of the inherited IRA account within 10 years. The distribution doesn't have to be distributed evenly over the 10 years. It just has to be withdrawn by year 10. If you already inherited an IRA account before January of this year, January 1st of this year, you are grandfathered in the old rules and can continue taking the required distribution over your lifetime. A key thing to remember is that these rules do not apply to spouses and disabled individuals, and minor children are also the exception. If your children are the primary or contingent beneficiary of your IRA assets, you may want to make sure they are aware of these new rules and have a plan in place. If you are the beneficiary of a recent inherited IRA account, we will work with you to develop a plan to optimize the timing of these distributions. If the ability to convert your traditional IRA funds is appropriate to a Roth account, this will be beneficial to your beneficiaries. While a required minimum distribution is still necessary for an inherited Roth account, the beneficiary will not have to pay taxes on these withdrawals. There are a few more other provisions to the Secure Act, but I just wanted to highlight the most important. If you have any questions, feel free to ask now or send us an email offline.
Joanna, it looks like we do have a couple of questions on this. Can you address, there's a little bit of a quirk, if you will, in the rule between the RMD age being increased to age 72, but someone being able to actually continue to do qualified charitable distributions before age 72, even though they don't yet have an RMD. Can you just talk a little bit more about that?
Right, so a qualified charitable distribution, you can still take even if you are not required to make your RMD, since you're not 72 yet. So you can still continue doing the charitable distributions at 70 and a half. And then at 72, your RMD kicks in and you can use those QCDs to count towards the RMD amount.
Okay, great. A second question here is, a great question. Is there any way to avoid the new required minimum distributions from inherited IRAs? Can you do something like set up a trust?
So you can set up a trust. You can do it in a irrevocable trust. The only problem with that is because typically IRA assets pass to beneficiaries directly. If you name a trust as a beneficiary, the funds will pass according to the instructions of the trust. So it's probably best to contact your estate attorney to make sure the writing on that is clear so that they avoid having to take the full RMD in year 10 or avoid having the distributions taxed at trust rates, which can be as high as 37% on the federal side.
So if the question was around potentially being able to avoid the new RMDs to avoid taxes, is there any way to avoid taxes on the required minimum distributions?
Sure, you can convert the traditional IRA funds to a Roth account. Like I mentioned, a Roth account, you still have to do required RMDs for the inherited beneficiaries, but because it's in a Roth, those funds will be withdrawn tax-free.
But the bottom line is, at the end of the day, there's no way to avoid paying taxes. The money's going to have to come out of the account at some point, and whether it's in a trust or what format it's in, there's going to be taxes owed.
Correct. It's either going to be the current IRA owner by doing the Roth conversions, or it's going to be the beneficiary when withdrawing the funds. Okay. Thank you for the questions. I will now pass it over to Rachel, who will go over the TD and Schwab merger.
Hi, everyone. So I wanted to talk about the TD and Schwab merger. As most of you, if not all of you, have probably heard, this is in process. So the main takeaway that we know so far is that for now, it's just going to remain business as usual. The deal is expected to close in the second half of 2020, but it is still under the Department of Justice review. There's some antitrust regulation that it needs to pass through and be approved for. So it's a very slow moving deal. Another important takeaway is that we won't need to repaper accounts, which means that on your end, we will not need very many new signatures, if any. So it shouldn't really affect you whatsoever on the paperwork side and should be fairly straightforward for us as well. The estimated technology transition, TD Ameritrade is on a different technology platform than Schwab. And so anything client facing will probably take place 1 to 2 years after closing, which as I mentioned, won't happen until at least the second half of 2020. So while we don't know a lot at this point, we do know that nothing is happening in the near future and you won't be affected, and more than likely we will not be affected as well for the foreseeable future. So there is some good news that comes along with this merger. Schwab has more banking and cash management capabilities, so we'll be able to offer a little bit more of a robust service offering in that area since Schwab has a greater capability built out. And then based on user feedback, Schwab also has a more intuitive user interface, which means that it will be easier to use their platform and portal moving forward. Oh, it looks like we already have a question. Mike, could you please read that to me? I can't actually read it.
Yeah, the question is, will the recorded webinar be sent so that it can be shared with family members? Yes, absolutely. We will we'll send out an email to everyone with a link early next week to a recorded version of this. And if you'd like to get a copy of the slides, just shoot anybody on the team here an email, and we'll be happy to email you a PDF.
All right, so going back to the merger, those are the main takeaways at this point. Like I mentioned, we really don't know a whole lot, and TD and Schwab also don't know a whole lot at this point since they have to pass the antitrust review and Department of Justice regulation and review. So if you have any more questions, feel free to put those in the chat window. Oh, it looks like we have another one. Oh, it looks like the sound isn't working for one of our users. So I will try to talk louder. Does anyone else have any questions about the merger? Okay, with that, I'm going to turn it over to Bryn, who will be talking about a new portfolio management system that we have in the pipeline for you.
All right, thank you, Rachel. So I'm going to speak briefly about an internal transition we have for our portfolio management system. To give this little context on how this transition will affect you, this software pertains to any documents you'd receive in the vault for quarterly reporting or performance reporting. All right. So the system we currently are using used to be an industry leader for financial reporting, but the parent company has discontinued investing in the platform to keep up to date with today's technology and account reporting needs. Because of this, Aspen Capital decided to look for the next generation of software that would be more robust and innovative for years to come. The new software will have stronger interface and technology capabilities. Rachel and I actually just got back from a training conference to learn more about the nuts and bolts of the system. And there are many benefits you will see from this transition, including a more robust and rich client reporting. So this will affect how and when you can see performance reports and data in real time. So rather than waiting for quarterly reporting, you will have access to real-time data in your new client portal. The new platform has more integration capabilities, so the new client portal will include a new document vault and integration with our financial planning software. So you will be able to access all three: reports, the vault, and financial planning software within that login. We believe you'll notice a better and more modern user interface for the client portal and reporting. And then lastly, we'll be rolling out a mobile app so you can access all this information on your phone. We are planning on rolling this out to you in the second half of the year, and Rachel and I are working hard to build out trainings and resources for you to make the transition as smooth as possible. As the time comes for the transition to fully take place, we will be sure to send out any updates and information necessary. And with that, I will send it over to Katie.
Great, thank you, Bryn. Well, I have the great opportunity to share with you guys about DFA fees, and this is good news. So some good news to deliver to you today. Your expense ratios are going down. Isn't that music to our ears? Okay, before we get into the actual numbers of your expense ratio, let me just remind you what an expense ratio is. So that expense ratio is a fee that you pay to the mutual fund company to invest in the mutual fund. It's a small amount, but can make a really big difference over time. DFA is already known for offering low-cost funds, and then in December of 2019, they just announced that they'd be reducing fees on 77 mutual funds in February of 2020. So that should take into effect actually today. So if you look at that table, this is a good summary of the majority of the DFA funds that our clients own or hold in their portfolios. If you start on the left side, you can see the ticker symbol of the mutual fund. And as you move over to the right, you can look at the 2019 expense ratio versus the 2020 expense ratio and the difference in that final column and the savings to you. Again, it looks small, but over time, it does make a big difference, and we're really excited to announce that lower fee. So DFA, this isn't the first time they've lowered fees. They actually also lowered in 2015, 2017, and 2019. And if you want to know the comparison amongst their peers, they fall in the bottom decile for that expense ratio. So really low fees compared to their peer group. So I'll end this with just a quote from the DFA co-CEO. He said, "We expect to do better than benchmarks and peers, net of fees. So we fight for every basis point." And that's why we can roll this out to all of you, and you can expect your expense ratio to go down for 2020. Good news. Okay, and with that good news, follow that up with some information on the presidential election for this year. Joanna's going to take us through some thoughts on that.
Okay, so election day is about 8 months away. And while outcomes of the election are uncertain, one thing we can count on is that plenty of opinions and forecasts will be out there in the months to come. And in the financial world, this will assuredly include any potential for perceived impact on markets. So on average, market returns have been positive in both election years and the subsequent years. Let's take a look at historical returns of the S&P 500 during these years. The gray bar in this chart represents the returns during election years, and the green bar represents the return following the election. You'll see the average return of the S&P 500 since 1928 during the election years has just been a little over 11%. And the year following the election year, the return has just been at about 10%. So if you recall, before the 2016 election, there were different opinions about how the election would impact markets and that stocks would fall if Trump were elected. However, the following day after his win, the index closed 1% higher. This goes to show that it really is impossible to identify systematic return patterns during these election years. So let's also take a look at this chart that looks at market returns of the S&P 500, but under different presidents since 1926. The red area is when a Republican president was in office, and you'll see the blue areas when a Democrat president was in office. You see here, each presidential term has periods of significant growth, and there's also significant declines during their term. But what you don't see is a pattern of stronger returns when a Democrat is in office or when a Republican is in office. So really, the bottom line is markets have historically continued to provide returns over the long run. And as an investor, that you're really no better off regardless of whether a Republican is in office or a Democrat is in office. Ooh. Sorry about that. So we want to remind our clients to not make short-term changes to your long-term plan to try to profit or avoid losses when changes in the political world arise, and to rely on portfolio structure rather than outguess the market to pursue investment returns.
Thanks, Joanna. Great thoughts. Looks like we do have a question, so let's take a look at this here real quick. Oh, another request for the slides. Well, we are so happy to give these slides to you. Again, we'll be sending out a link that will take you to our website early next week so you can download or review the video. And then if you actually want a copy of the slides, we've got your name down. We'll make sure to follow up with you, or you can email us after this, any of us on the team, and we'll send you the slides in a PDF via email. Okay, so great thoughts there from Joanna on what we can look to for the upcoming year, how we can react to the presidential election. And with that, we'd just like to close by reminding you to focus on what you can control. So we can't control who the next president is. We can vote, but we can't control. We can't time the markets. We can't outguess the majority or silence the media. But what we can do is a couple things within our power. We can control our risk management by using proper asset allocation, making sure that that's still aligned with our risk tolerance. We can be in globally diversified portfolios. We can reduce expenses, which we've talked about in the DFA, lowering their expense ratios. We can minimize your taxes in practicing good asset location, which we do for all of our clients. We can remain disciplined and disciplined really to our financial plan and our withdrawal strategy. So take some solace in the investment strategy that you've adopted. It's a goal-focused and planning-driven approach, not a market-focused and current events-driven strategy. Investment failure results from continually reacting to current events in the economy and the markets. We're in it for the long term. Success comes to those that continuously stick to the plan. And with that, we've got one more quote for you to look at. This is from David Booth, Executive Chairman of Dimensional Advisors. And he said, if you're living in fear of the next downturn, consider shifting your thinking instead of your investments. And now we'll just open it up for questions. Okay, just some comments here more than questions. Mike, do you have any questions, anything that you want to wrap up with?
No final thoughts from me. I'm looking around the table here. It looks like everyone's shared their thoughts. As we said, we will be happy to get out a link to a recorded version of this early next week. We will also go ahead and send the slides to just everyone that registered for the webinar so that everybody gets a copy of it. Please feel free to pass on the link to the video. If you've got friends, family members, coworkers, colleagues that you think would benefit from the information, please feel free to pass it on to those folks. And likewise, if this information strikes an interest in you, or you come up with a question over the weekend, please feel free to reach out to anybody on the team here, and we'll be happy to take care of your questions next week. Other than that, have a great weekend, and thanks again for joining us.